Welcome to Wyckoff Power Charting. My name is Bruce Fraser. I am your host, and today we are going to talk about the secrets of how stocks move revealed. This is episode 12, recorded on October 16th of 2018, to be aired initially on October 19th of 2018. And I am with my co-host, Roman Bogomazov. Welcome.
Hi, Bruce. Happy to be here.
Excellent. Well, I'm intrigued with this title.
Yeah,
Secrets of How Stocks Move Revealed. Do we really want to reveal these things?
Well, I think that's what we're going to do, but I wonder what kind of secrets we're going to have today to reveal.
Well, we're kind of changing directions with today's episode, and we're going down maybe a slightly different path than prior episodes of Wyckoff Power Charting. It's very important what we're going to do, and we want to build a foundation of knowledge about the Wyckoff methodology that can allow us to build our knowledge base. We want to become better and better and better at Wyckoff. Wyckoff is a mastery process, and this building our knowledge base is going to allow us to be able to achieve ever higher levels of ability with Wyckoff. Roman, your thoughts?
I'd say let's go for it. And
okay. Well, let's do it.
Let's do it.
Well, first of all, we are highly motivated in helping you to develop your Wyckoff skills. And so we have lots of content for you. First of all, we have a Wednesday afternoon, 3 p.m. Pacific time program every week, Wyckoff Market Discussion. And here we do Wyckoff analysis on the broad reach across markets, commodities, stocks, interest rates. We're looking at everything as it becomes topical and important to us. So this is last bar analysis. I mean, we definitely cover different time frames and analysis, but always with an orientation towards the current. Roman, your thoughts?
I like this class for us on Wednesdays because we are discussing a ton of stuff. We start with the markets, we go through the sectors, industry group, stocks, we look at the futures, and students also bring to us a lot of their own ideas. They send us their charts that are labeled, and we go through their analysis. So we give our feedback to them. And I think that's a very popular feature of that show.
Well, I love that aspect of it because we really do see how our students are growing in their capabilities and becoming better and better and better. And we get great feedback about how this is really helping them to be ever more effective in their market campaigns. We'd like to invite you to participate in an episode, one of our programs, and you can do that if you have not attended in the past as a free invitation, is to email us at this email that Romana circled, and just make a request to attend a Wyckoff market discussion. We would love to have you there as our guest. So additionally, we have my blog, which I publish on Stock Charts. You can see there that it's stockcharts.com/articles/Wyckoff, but you can also just go to the homepage, click on blogs, blog articles. You'll see a drop-down list of the different blogs that are available, and mine is listed, Wyckoff Power Charting. And all that content is free, and we would love to have you come check that out. And then, Roman, tell us about the Wyckoff education on YouTube.
Well, first of all, it's also free, which is always great. So go on YouTube, find Wyckoff Trading Method channel. And there we have, I think, around over 30 videos from different classes, including samples of, let's say, Wyckoff market discussion class. So you could view that video and sample and see what kind of analysis or what is the structure of that class. And then we have examples of other different classes that we have. There is a video blog as well that concentrates just on the post analysis of trades and so on and so forth. So there is a bunch of stuff that you could go through and educate yourself even just from that offering. And then if you are more interested in Wyckoff method as an educational tool that you want to develop, for your trading, then go to wyckoffanalytics.com and you could see all of our offerings there that are educational offerings. And obviously, just contact us at Wyckoff Associates at gmail.com. Whether you want to contact me or Bruce, we'll find the way, to get those emails to the correct person.
Terrific. Well, it's just too much free stuff.
Yeah, that's true.
Yeah, it's just, there's a lot to do there. So anyway, well, let's get to work. The whole notion here about the Wyckoff method is that this knowledge base, everything builds on something below it. It's just one concept after another that are very important to understand for us as Wyckoffians to be able to really execute on the methodology. And so we're taking a step back today, and we're going into the most very important basic understanding of the methodology, which is that Wyckoff is based on the concept of price cycles. So we know the price cycles exist in financial markets. And for instance, Martin Pring does some of the most incredible work on price cycles, and it's remarkably good work. You should study him very carefully. Wyckoff understood the notion or the importance of price cycles, and he built a whole methodology around price cycles that's very unique and really unlike anything else. And so you can see here that the price cycle includes an oversold condition. Now, think of this classically as being a 4 to 5 year phenomenon, business cycle. Price cycles occur in smaller time frames, and we use Wyckoff in those smaller time frames. And so keep that in mind. But here, let's just think in terms of the classic 4 to 6 year business cycle. So we have an area of an oversold condition, economy's weak, stocks are cheap, they've been declining because of recession, conditions are bad, and pessimism is very high. Pessimism among institutions, individuals, the news helps to keep people, out of the market. Well, this is classically an oversold condition for a number of reasons. It's also a place of very high value for stocks. You look back on these periods and you look at it and say, hey, stocks were really cheap back then. This, in Wyckoff terms, is an accumulation area. And there's a process that the market goes through in accumulation that prepares a stock for the uptrend, the markup phase. So you can see here that we have this long extended period of time where prices just go up and up and up. This is the markup phase, and this can take years. And at the conclusion of the markup phase is an overbought condition. Stocks are loved, they're overowned, the economy is very strong, earnings are really good. All these things are happening that are creating sort of a happy glow around the financial markets. At that point, distribution sets in. And this is the condition where stocks are being sold by large informed interests because they can see that conditions are changing in the months and years to come. They have this ability to see the future in a way that most people and institutions cannot. So then that produces distribution results in markdown. Ramon, your thoughts?
All right. Well, let's reminisce a little bit. Let's start with the accumulation area. And Bruce mentioned that those are places of high value for stocks. So I want you to remember the accumulation areas that were at the bottom of, let's say, 2008, 2009 cycle, where the price went down drastically. And then we had a period of accumulation from which the price was marked up, and it's still in that big secular trend. So remember those times. Those are going to be generational lows. So, for instance, 2002, 2003 low, 2008, 2009 low, 2015, 2016 lows. Those are the areas where big institutions, and we're going to call them the composite man or composite operator, accumulate shares on the pessimism from everyone else, and they are holding on to that supply of shares, and that allows the price to start moving up because there is no more supply, or the supply is so exhausted. And as we go through the markup, we might have situations, and we'll discuss this, we'll show you, where we're going to stop for a little bit, go into the trading range, into the consolidation, move up again, stop again, and the price is going to have a specific structure, and then conclude that with the distribution. And Bruce is so correct that in the distribution area, we're going to have the most favorable economic news possible. And that's what's going to attract a lot of the public hands or weak hands and they're going to be extremely excited at this point, because at that point of time, when distribution happens, the uptrend has been advertised so much and everybody wants to participate. So on that excitement, institutions are going to give out their supply of shares that they've accumulated in the oversold condition to weak hands, and this is how distribution is going to happen. Once distribution by strong hands has happened, there is no way that the price could go up. Maybe marginally, but usually if big institutions do not support the demand and buying behind price action, then the price is just naturally going to start decreasing, and on the pressure of no institutional buying is just going to collapse and it's just going to go into markdown. Bruce?
This is why this business is so difficult, is because in an accumulation area, we're being advised to accumulate shares when the news is bad. And at the distribution area, we're being advised to sell our holdings when the news is glowingly good. And so it goes against public or personal nature to do the opposite of what the public or what even most institutions are doing. We're selling when they're buying, we're buying when they're selling. We're following along on the footprints of the composite operator. Composite operator understands these conditions and these issues and uses them to their advantage. They accumulate when value is good. They accumulate when pessimism is high. They distribute when news is good. They distribute when value is low. And so this process can only occur because there's a logical, sequential series of events that occur in price analysis, in how prices are behaving, that tell the Wyckoffian that a markup phase is beginning or a markdown phase is beginning. We can see the footprints of the smart money, these large informed interests. We can see their footprints in the combination of the volume characteristics to the price characteristics. And this accumulation area is a whole process. It's a whole school of thought that we develop as Wyckoffians in this methodology, which allows us to understand when accumulation is beginning, when accumulation is moving towards conclusion, and at the end of accumulation begins this very robust marking up period. That's the time that we want to be involved in this particular stock or in the market as a whole. We do this analysis on individual stocks, we do it on commodities, we do it on bonds, we do it on the market as a whole. And so this analysis is essential to our being able to stay in alignment with the smart money. Roman?
Smart money is going to be concerned about the accumulation in this oversold condition. And for us, what's important is to understand how the trend emerges, as Bruce said. So we are going to operate right here on the right edge of the accumulation. We want to come into the position when we identify the trend emergence, and then our most optimal, most efficient exits are going to be all around the area where distribution is starting to take place. If we are short sellers, our strategy is going to be the same, only reversed, right? So we're going to mark down, and we would want to be, again, on the right side of the trading range, initiating high probability trades right there for the further decline. Bruce?
We have talked in prior episodes, you've probably seen us on video in other situations, or also read my blog, where we have talked about the unfolding sequence of events that occur in prices as accumulation goes from beginning to end, markup begins. Distribution from beginning to end, distribution becomes markdown. And so you have some idea of how this process unfolds, but what we want to do here is we want to establish this foundation, and then we want to then start to develop your knowledge base on these, how we would analyze the individual charts to be able to know where we are in this unfolding sequence of events.
Bruce, you mentioned a term, composite man. What is it, from Wyckoff perspective?
Well, Wyckoff was active in the industry back in the beginning of the 20th century, up to early 1930s. And he made it a point to understand how the really large, informed, capable interests in the market were able to continually make money trading, right, and campaigning stocks. So he studied these very capable people. People like J.P. Morgan, James Keene, Jesse Livermore were the peers. These were people that he knew. He watched them. He studied them. He found people that knew how they traded and learned these processes and developed it into the methodology that we study today. We don't believe the methodology has really changed, that this is the way that large informed interests have to operate to be able to be successful, because they're wielding so much investable funds. They have to be able to accumulate large positions in a way that allows them to do it without moving the market. They don't want to move the market until they have their position on. And there are many great composite operators today that we could turn to and watch and study. We believe the Wyckoff method continues to have merit because these are the best practices of these people today as it was in the time of Mr. Wyckoff. And so there are ways that the composite man or the composite operator accumulate shares so that they carefully do it quietly, large position sizing, and are able to do it without putting the price up on themselves and causing themselves grief because they have to buy at ever higher prices. They're very good at that. But we can see the footprints of their operations in the charts. And if we know what to look for, we can identify where they are. And this is a logical process where when you see a accumulation unfolding in a stock chart, it has to reveal certain events occurring. And those events are, in the case of the composite operator, them accumulating shares and effectively removing those shares from the marketplace. they literally buy so much stock. And the composite operator is a number of large operators, and they're all working towards the same goal of building a large position, and they're all thinking the same thoughts at the same time. They effectively are removing liquidity from the marketplace. They're making the stock in question difficult to buy. And this is called absorption. And when the stock becomes sufficiently difficult to buy, and there's just a little bit of additional demand that's put into the marketplace, it pushes the stock into an uptrend, and the stock can move easily upward because stock is scarce. Ramon?
I think that was perfect, Bruce. Why don't we show our viewers the whole price cycle as an example now?
Okay, what are we looking at here, Ramon?
Well, we showed you guys the schematic of the price cycle, right? And it looks something like this, where we had an area of the accumulation, a markup, distribution, and then a markdown. So here is an example, the actual example of the price cycle on the Chipotle Mexican Grill, CMG. We are seeing a downtrend that concludes with the stop in action and concludes with an area, and actually I would extend this area, to make it a little bit larger, where big interests are accumulating on the way down and then on the way up. They are getting into this position in this area. This is the value zone for them. And they're expecting that valuation for this particular stock in the future is going to be way, way higher of where they are buying. They're also willing to hold on to this position for quite a long time. Remember that, Bruce has mentioned it's usually a business cycle that they look at. And here we see that accumulation has started at the end of 2008 and throughout 2009. And then look how long it took for the stock to be distributed at the end of the
6 years, low to high. That's
Mm-hmm.
6-year expansion.
Yeah, so 6 years. So that's their time frame. That's how long they're willing to hold on to this position and distribute on the most euphoric actions by weak hands. And throughout the markup, as the price goes up, think about weak hands that are going to be really excited to come into the stock and propel the prices to go even higher. And it's on this excitement, the composite operator, those big institutions, they're going to start selling. And we're going to see a specific volume signature that is going to be associated with the distribution by big interests. And that's going to not only stop the uptrend from going further up, but also it's going to start putting the pressure on the price. And at some point, the price is going to follow the effort to the downside, and the markdown is going to start. Bruce?
For you swing traders out there that just operate in shorter time frames, it's still important for us to identify the stocks that are under the strongest accumulation, that are being held tightly by these large interests. Because even if we want to just trade in the smaller time frames, look at these reaccumulation structures as we're going up, and look at the upward tilt to these. So knowing that CMG is in strong hands and is tightly held by these very large informed interests that are going to hold this stock for up to 6 years, this is the stock that we want to campaign in an upward stride. This is the stock that we're going to want to participate in our swing trading campaigns. And so even if we're a shorter time frame, this information is essential to us. Notice back in 08-09 that it was 2 quarters of from the beginning of the accumulation area with a climactic decline, 2 quarters where it traded in an accumulation range and then went right into an uptrend. And in that first reaccumulation, which Ramon says is part of the original accumulation, I totally agree with that, is that the stock was so tightly held that most institutions had to accumulate their shares on a rising scale above the accumulation zone. And the other thing to notice about this, go back and look at this period, is that these higher lows that were made right after the beginning of '09, the S&P 500 was making lower lows. It was still marking down to lower prices and building a big base. And here was CMG already in a markup. It was so tightly held that they couldn't hold it down to complete their position building. So this is just such a great example. And it shows how relative strength showed up in the base, in the accumulation, because the stock was being so aggressively bought by these really large interests. So anyway, swing traders need to be aware of this phenomenon also and trade in these stocks that are so tightly held, because you can see the phenomenon of this uptrend in this beautiful chart here.
Well, Bruce, let me continue this discussion about the benefits, the trading benefits. I mean, for all of you guys who are traders, swing traders, think about this. If we know how the price is developing the structure during the consolidation, we could define the timing which will allow us to participate in the next swing. We don't have to participate in the next consolidation. We could define the timing of where the price will start moving away from the consolidation. And we can do this each time in the uptrend until it's actually done, until we actually have a distribution. And then our bias is going to change from up to down, and we're going to find still high probability places for the timing of our swing trades. And obviously there is more to that. There is more technique as to how we should analyze this and how we should actually execute our trades. But the big picture is this. This is the price cycle, and we should define where we are in the large price cycle before we take any of the trades.
Now, what this does is it alludes to what we intend to do in future episodes, which we want to then lead you into a discussion on accumulation, because there's just incredible magical attributes of the accumulation unfolding that we want to develop an eye for as Wyckoffians. And also these reaccumulations all have similar concepts. So in future episodes, we're going to talk about accumulation. We're going to talk about distribution. We're going to zoom in, and we're going to understand the concept of these things. And so we want to set this up for you with this discussion today. And in the weeks to come, we're going to get into specifics on these concepts.
Let's go to free stuff again. We're giving out today a lot of the free stuff.
Oh my gosh. Okay, go ahead, Ramon.
Well, first of all, Bruce has a lot of writing on the price cycle. So Bruce, is this one of the first blogs that you wrote?
That is actually the first one that I wrote.
Oh, here.
Yeah, May 11th, 2015. So this is basically some writings on what we discussed today. So please take some time to read that. And actually the future blogs from that lead into our future discussions here on PowerChart.
And then you could also go to our YouTube channel, Wyckoff Trading Method, and there is a ton of free stuff, and specifically Wyckoff Trading course discusses the price cycle.
Ramon, that's the sound that we're done.
Yes.
Thank you so much.
Thank
you. We'll see you all next time.
Bye, guys.